Here is the summary of the latest articles and how to solve the pension problem learned from the true story. So let's get started. The yield on the 10-year US Treasury note is at 3.547%, and the chart for the week yesterday was quite volatile. It rose to 3.6% and then fell. All three indexes lost 1.7% or more. The S&P 500 chart is pretty bad today. Here is the low level of the price from the beginning of the year. According to current forecasts, it is likely to fall below that point by the end of the year. When you look at the charts, please check not only the daily ones but also the weekly and monthly ones. This is September and it will soon be over. But if it keeps going like this, it will be a negative line for the second consecutive month. The Nasdaq is also a big negative line today. The long-short interest rate differential between the 10-year US Treasury yield minus the 2-year yield is now minus 0.53%. This level has only happened a few times in the past. Historically, a deep inversion of the yield curve like we are seeing now means that the likelihood of entering a recession is very high. With today's drop, the performance of the indexes since the beginning of the year is finally down more than 20%, with the Nasdaq down to 28% and the S&P 500 down more than 20%. We are once again in a bear market. However, I feel that there is still not enough fear. Probably during Chairman Powell's speech last night, the price of VIX rose to 30, but then dropped again to 27.99. Now let's get back to the latest pre-filled summary of the FOMC meeting. The Federal Reserve raised its target interest rate by 0.75% to 3.25% on Wednesday and signaled more large increases to come in a new projection, showing its policy rate rising to 4.4% by the end of this year, before topping out at 4.6% in 2023 to battle continuous strong inflation. This is close to what market participants were pricing in. In that sense, it can be said that the Fed has finally caught up with the market participants' consensus. The series of big rate hikes are expected to slow down the economy. GDP growth is forecast to slump to just 0.2% for 2022. The previous forecast in June was for 1.7% growth, but this time the forecast has been revised downward to 0.2% growth. This means that the repeated interest rate hikes are starting to have a negative impact on the real economy. However, despite the slowdown in the overall economy, the labor market is stronger than ever. The number of job openings to job seekers is close to 2-to-1, which means that the labor market is overheated. This suggests that a wage inflation is likely to occur. The most striking aspect of Powell's press conference was the Fed's attempt to find a way to cool this labor market malaise. The summary of economic projections from the Fed showed the unemployment rate is estimated to rise to 4.4% by next year from its current 3.7%. Of course, the lower the unemployment rate, the better. The message from the Fed is that this level of deterioration in the employment market is unavoidable in order to curb inflation. Indeed, in the long run, the Fed expects core inflation to settle around 2%. However, the forecast for the end of this year is 4.5% compared to the 2% target. This is significant overshoot. This is a sign that the Fed will need to stick to a tight interest rate policy for the foreseeable future. The FOMC meeting was largely in line with expectations and lacked surprises. However, Chairman Powell emphasized more than usual his stance that future interest rate policy will depend on price statistics. In this connection, I think the meeting left the impression that the Fed is being swayed by the near-term CPI release. In other words, we investors should pay attention to the monthly CPI release, and there was little comfort in the Fed's message. So how do we solve the pension problem now? The problem of underfunded pensions is a global problem. It's about moving to private sector. The answer to this question has already been found around the world. This is what pension experts recommend, and the countries that start doing it early are the ones that have the healthiest pension systems. High-scoring countries are Finland, Denmark, the Netherlands, Norway and Sweden. Many Nordic socialist countries are included in this list, and these countries have regained their pension systems' health by shifting them to the private sector. Countries such as the Netherlands, Denmark, Finland, Sweden and Norway have implemented a series of pension reforms in recent years. They are rushing to shift to market-based funded pension plans. In countries such as Denmark, the government, business and the public have worked together to avoid the collapse of the pension system. But no matter how much you turn away, what is essentially bankrupt is still bankrupt, and it needs to be faced. As far as I know, no country has completely redone the pension system from ground up. They have all been restored in an eclectic manner by tying them together with private defined contribution plans to make up for weaknesses in the levy system. The levy system is part of the money pot. There is nothing more we can do about that, so we need to increase the defined contribution, at least for the new money portion that people will be contributing in the future, and make it their own personal savings. That will not be diverted to the government or other generations. You can start with an index fund that invests in global or US stocks and bonds. And here is a little explanation of how compound interest works. For example, let's say you're about 27 years old and your annual income is about $35,000. Then the amount you can accumulate each month would be a little over $70. For the sake of simplicity, let's assume that you accumulate $840 per year. Let us assume that you continue to do so for 38 years until you retire at age 65. If that is the case, the annual rate of return is 2.2% at most. So, if you substitute that figure, the amount of savings after 38 years will be only $52,320. This is a 100-year life period, and you will run out of money along the way. Let's do the same calculations by changing from bonds to the S&P 500, a representative US stock index. In the past 58 years, the S&P 500 index returned an annual rate of 9.8%, including dividends and reinvestment. Using these data, the amount would be $350,000, although you are accumulating the same $840 every year. So don't be careless in choosing where to invest.